Let's kick off this explainer by looking right behind the curtain to see how billion-dollar investors actually think. We constantly hear about retail investors, right, chasing the next big stock. But the massive players, sovereign wealth funds, pension funds, private equity, they operate in a completely different universe. To really grasp this mindset, we're going to start with a wildly counterintuitive bet, one made by Kotak Alternate Asset Management right in the teeth of a global crisis.
Think back to the absolute height of the COVID pandemic. You remember the news. The international press was flooded with really distressing imagery out of India, and this prompted a lot of foreign investment committees, sitting thousands of miles away, to just flat out reject the idea of deploying capital there. Seriously, when memos crossed their desks suggesting investments in the region, the typical reaction was, literally, don't waste my time. The perceived risk was just off the charts.
But see, here is exactly where the institutional mindset kicks in. While retail investors hit the panic button and global sentiment fell off a cliff, the smart money was looking for the opportunity hiding in all that adversity. Over an 18-month window during that exact crisis, Kotak Alts deployed a staggering $800 million across India. And the result? Every single one of those investors ultimately made more than a 20% return. They were able to completely tune out the media noise and focus purely on ground reality. So, now that we've seen how institutional money behaves when things get rough, let's quickly run through our roadmap for today. We're going to cover the billion-dollar mindset, the India investment paradox, spotting decadal megatrends, the power of patient capital, and finally some lessons for everyday investors.
All right, jumping right into Section 1, the billion-dollar mindset.
There's this massive behavioral gap between everyday folks and huge institutions. Retail investors, well, we tend to chase hype, right? And we rely heavily on public markets, where if you get scared, you just panic press a sell button on your app. But institutions, they operate in private markets. They can't just hit sell overnight. Because they are locked in, their absolute first instinct is capital preservation. They literally surround their money with these complex risk matrices long before they even glance at the potential upside.
And just to grasp the sheer scale of the capital we're talking about, take a look at the 2026 Capgemini World Wealth Report. Global high net worth wealth just surged to a record $98.3 trillion. Trillion. That is the largest single-year jump since 2018. It's an absolute ocean of wealth, and it's constantly shifting the global financial landscape as it searches for a productive home.
Now, look at how these ultra-wealthy individuals break down their portfolios. Equity sits at 25%, fixed income at 20%, and alternatives are at 12%. But here is the real kicker. A massive 68% of these folks are actively looking to increase their exposure to private equity. They know something crucial. Long-term, uncorrelated wealth isn't built by day trading on an app, it's built patiently in private alternative markets.
Moving on to Section 2, the India investment paradox.
Okay, so global investors don't just throw darts at a map. They use a highly analytical, ruthless scoring system. When they look at India, they factor in currency risks, sudden regulatory shifts, and how hard it's going to be to eventually exit. And every single red flag adds a premium. So if an investor is perfectly happy with an 8% return in the US, they're going to demand 15 or 16% in India just to justify taking on all those extra layers of complexity.
And it gets trickier. Out of roughly 8,500 listed companies in India, you'd think the options are endless, right? But when massive global institutions apply their rigorous governance and quality filters, basically making sure companies are focused purely on the business without any governance red flags, that universe shrinks drastically. They're left with only about 200 to 400 truly investable companies. This intense scarcity is exactly why the valuations of these top-tier Indian companies often look incredibly expensive compared to other global markets.
Which brings us to Section 3. Spotting decadal megatrends.
This timeline is a perfect example of how patient capital stays way ahead of the curve. Back in 2020, Kodak recognized India's massive digital public infrastructure boom. They poured money into data centers long before the current AI hype took over. Why? Well, they knew hosting domestic data wasn't just a fun tech play. It's quite literally sovereign security. They bet on a structural reality. Fast forward to 2024, and they were actively avoiding the early, wildly overpriced AI hype, where real functioning business models didn't even exist yet.
Honestly, their philosophy is perfectly captured in this idea right here. Entrepreneurs should build value, not chase valuation. Smart, billion-dollar investors know for a fact that true wealth is created by solving genuine problems over long periods. While the media is busy throwing a parade for the newest unicorn valuation, seasoned investors know that execution matters so much more than the initial idea. For every startup that becomes a household name, there are dozens that quietly fail because they were too busy dressing up the company for a funding round instead of building a sustainable, resilient business.
Let's shift to Section 4, the power of patient capital.
A perfect real-world example of patient capital at work is an INVIT, or an infrastructure investment trust. Think of an INVIT kind of like owning a piece of a national toll road. As the economy grows and trucks keep moving, tolls are collected. But crucially, these tolls are usually linked to inflation. So as inflation goes up, your payout goes up. And by law, the majority of this free cash flow has to be distributed back to investors. It gives patient capital compounding consistent, inflation-adjusted cash flows over decades. This is exactly the kind of boring, highly productive asset that global institutions absolutely love.
But here is the really fascinating, kind of frustrating twist. India actually has its own massive pools of domestic savings. We're talking trillions of rupees managed by entities like the Provident Fund and Life Insurance Corporation. Yet, their allocation to productive assets like infrastructure is near zero. Most of this domestic wealth is just parked in low-yield government bonds. And because domestic capital is playing it so incredibly safe, global pension funds just swoop right in, buy up these infrastructure assets, and reap the rewards of India's massive long-term growth.
Which leads us to a pretty profound realization. Building wealth literally equals building the nation. If India can channel its own domestic pension funds and insurance capital into alternative assets, it reduces its reliance on volatile foreign capital. And more importantly, it ensures that the immense wealth generated by India's infrastructure revolution over the next few decades actually stays in the pockets of its own citizens and retirees rather than flowing overseas.
Finally, let's wrap up with Section 5, Lessons for Everyday Investors.
So to invest like a massive institution, you obviously don't need billions of dollars, but you absolutely need their discipline. Step 1, prioritize capital preservation above everything else. Before you ask how much you can make, ask yourself how much you could lose. Step 2, actively tune out the short-term market noise and demand execution over hype. Let everyone else gamble on the newest buzzword while you look for solid cash-flowing fundamentals. And Step 3, think in decades, not days. Cultivate patient capital that compounds silently over time, just like a toll road.
As we finish up this explainer, I really want you to take a hard look at your own portfolio and ask yourself one absolutely crucial question. Where is your patient capital deployed right now? Are you truly building long-term, resilient wealth, or are you just chasing the next quick exit? Take a page from the institutional playbook. Sometimes the most boring assets are the ones that quietly build empires. Thanks for joining me, and keep learning.